Hello and welcome to Tech for Non-Techies, the only podcast that demystifies the fast-growing technology sector. I'm your host, Sophia Matveeva, Chicago-based MBA and tech entrepreneur. My aim here is to give you the skills, knowledge and confidence to find opportunities in the tech sector, whether that's through founding a company, getting a dream job, or bringing a fresh perspective to your work. Hello, smart people. How are you today? I'm a bit tired, but also excited because I was up late last night. I know what you're thinking. It's not that. I've just started a new project to train some students in El Paso, Texas, on the basics of technology and entrepreneurship. And this project is funded by Blackstone. If you don't know, Blackstone is a huge global investment company, and I really like that they're investing in people learning this stuff. They did not pay me to say this, but I genuinely do believe that companies that invest in knowledge end up having better results and are better for the world. We had a kickoff session yesterday where I taught the first class, but it ended up being at midnight for me because I'm currently in France, and the time difference with El Paso is 8 hours. We have adjusted the time difference for the rest of our sessions though, so this is a one-off occurrence. Still, I really enjoyed it because I got to work with some really smart people. And smart people ask me smart questions, which tickles my brain, and I love that. For my new Texan students, if you're listening, I can't wait for more. We are meeting again tomorrow. If you want to show me that you're listening, then leave this podcast a rating, and in the review, just say you're part of that program. That would just make me super happy. Okay, what are we learning about today? In today's episode, we've got a double whammy. In one episode, we are covering technology entrepreneurship and venture investing. You will hear from James Saul, a venture capitalist at an early stage fund called Superseed based in the UK. James spoke to our community earlier this year, and this is an excerpt from our conversation. We've had a few venture capitalists on this show, and the pattern that you'll see is that venture capital is usually not the first thing that somebody does. So it is not the first stage in somebody's career. Usually, a career in venture capital is something that you transition into. One of the best things to do before working in venture capital is working at a startup. If you know what a startup looks like from the inside, then you're going to be better at investing in startups. In this episode, you'll also learn about equity crowdfunding and syndicate investing. If you want to raise money or invest in startups, this episode is definitely for you. Also, right at the end of this episode, I am going to tell you about a treat that you can participate in. And I am very excited about it. But without further ado, here is James. James,
Hi.
What is it that you do at your job?
What do I do?
What do you actually do?
You're going to get me fired. I do lots of stuff. I work at Superseed, which is an early stage B2B SaaS and deep technology fund. So we invest in companies very early on in their growth. So we are not sort of making investments purely off numbers and things like that. It's still at the early stage. So we're very much about the people and what they're doing and understanding their motivations and how they kind of act and react and things like that. So I'm a principal for Superseed. So my role involves some aspect of the capital raising, some aspect of investor relations, and then finding and sourcing and reviewing and then hopefully investing in interesting startups. So that's I kind of wear the sort of three hats, I suppose, on a daily basis. I'm also really father and my son thinks I'm a builder because I've been fixing things at the house. So I've got three kids. So quite a busy existence.
Well, so how did you get to this position? Not to the baby making because I know how that works, but to the job that you have now, because I know that a lot of our audience, they are
either aspiring VCs or they are thinking about making their first angel investment. I'd love to understand how you went from graduating in engineering from King's College.
Yeah.
And then what happened?
Post university, moved into technology. What I'd call technology, so not software, building real things and designing sort of physical machines and product design and manufacturing improvement, all these sorts of different stuff. Working on projects with global brands, Coca-Cola, Pfizer, Johnson & Johnson, within that, all sorts of different companies, looking at how to make their products better, design new products for them, all sorts of different things. So it's a nice sort of problem solving environment. Also consultancy, you get chucked in at the deep end very early. So I was, early mid-20s, would be given, in those days, printouts of lots of stuff and some PowerPoints to read and sent on a plane to fly somewhere and land and sort of be a semi-expert on day one. That was very fulfilling, but quite frustrating in my ability to affect my own sort of career path. So I actually moved into entrepreneurship quite quickly. So within sort of 5.5 years, I decided to leave and joined a friend had left about 6 months before me and had started work in the space. And so building his own company, and, I joined, and we started with very little and built it up pretty quickly. And yeah,
what does that company do? So I'd love to know about
so that invested in, that was looking at R&D tax credits as kind of a Trojan horse to get into companies.
For people who are in the UK who are watching this, who are going to be listening, R&D tax credits, I think tech startups love R&D tax credits. I have been very grateful to the UK government.
Yeah.
R&D tax credits.
Yeah, and established businesses, it's a great way, and it's a great example of the government trying to actively support entrepreneurship and technology and development and trying to push us forward. And what we would do, we go into a company knowing what they would have had to have done from a technical perspective. So all the design work and the sort of engineering side of things, knowing that they would have had to do all these different parts. We then were working with a tax specialist who then meant that we could help them with their applications. And the concept was we would go into a business, they would open up their wares and let us know exactly what they're up to, and we would help them secure, a better R&D tax claim, because we're making sure they cover everything that they should. The reality was that it was 2010, so most of the businesses were spending money that they hadn't got and money that were future turn up. So it didn't really work out in that way. But one of our clients was buying up IP to commercialize, and we were writing the technical due diligence for them. And so that's how I started to get into investments. So they actually acquired the company into the group of companies. And then I started work as investment analyst for them.
Sort of acqui-hire.
Yeah, so what they were doing, it was quite interesting. So they were buying up companies that were operating in sections of an end-to-end play for technology. So that the idea was that if you get the IP level, own an IP firm. If you want to get the technology and all the technical elements, own a technical consultancy. If you want the tax, own an accountancy. And so they were buying companies in each of these groups, each of these pockets of sort of knowledge. We bought a marketing company, a manufacturing company as well. And so the concept was we could take intellectual property and just generate value right the way through. And so, yeah, that's how I actually sort of moved into proper investing, I suppose. And I grew to investment manager for them within 2 years, and then decided to part ways. And I come from Cambridge, and so Cambridge is an exceptionally, privilege is not a really nice word now. It's sort of got massive, negative connotations, but I don't mean it in a negative connotation way. But I'm very aware that it's an extremely privileged place to be. It's got, some of the best academic brains in the world. It's got some of the best facilities in the world. Very low crime, very nice environment. Like it's just it's a wonderful place to be. Yeah, it's brilliant. Like it's great, and I'm fully aware of that. So
you're lucky. I mean, to be honest, I'm currently in the Côte d'Azur, so.
Okay. So, yeah. Great. better backdrop than mine. I think the sun's just going down, so not too bad. But yeah, so it's sort of very, very nice place to be, and there's lots of companies being built, and lots of interesting things going on. So I was actually very lucky to work in the technology company just outside of Cambridge. Then built my company and one of my friend's company in Cambridge, and then I got a new role at a company called Syndicate Room, which was a startup. They'd just closed, I think, sort of 300-400K in funding, and I really liked what they were doing. It felt like we were on the cusp of sort of a next wave of something in finance, and that something was equity crowdfunding as a sort of moniker, but in reality, to me, I saw it as retail. So just trying to look at ways to get direct to retail for investment products. And I then sort of, definitely had decided that my path was in investing, and sort of, went at it full time with these guys as well. So
Syndicate Room got quite big, didn't it? Because I remember that there were a few people who were saying to me, this is something that you should look at as a fundraising option. And am I right that it focuses on the startup market?
Yeah, so we're generally companies at the earlier stage, I left there a while ago now. So sort of generally focus on the companies at early stage, and the concept was to co-invest. So find companies that are being invested in by angels, VCs, family offices, corporate VCs, and negotiate the same terms as them for retail investors. And then offer a simple way for retail investors to go online and invest in an aggregate, so that we could end up with 100, 300, 500, 600K worth of investment to put into a round alongside professional investors. So then it meant that somebody from £1,000 can invest alongside VCs, all sorts of different people. So it's kind of in my mind, it was the potential to be the private equity version or early stage version of what eToro is, where you have eToro, where you have traders and you have people that are kind of mirroring their trades. In my mind, that's what it sort of looked like. That was the sort of initial concept from my perspective. So I joined there. There was 4 of us. Very small space, lots of other companies and startups all around us, lots of Post-its on walls trying to work out what to do, and like super early stage. Really enjoyed that. It's tough. You're T-boy to CIO. I was chief investment officer, not chief executive, but sort of top to bottom all in one person, and it's good fun. Like it's super interesting. Probably, I think, organized investments into well over 200 companies in the time that I was there. I built and designed the first passive fund for early stage investing, which we, us and a pretty small team took to market. And that was the first, as far as I can see, still no one's sort of found one that's earlier, but that definitely in the UK and almost certainly in Europe and potentially in the world, that it was the first early stage fund that was built in a passive way. So you're looking sort of trying to get the difference between active and passive invested money is that active is very much driven by a decision maker or makers. So you have a group of people that decide where to allocate capital. Passive is looking at not trying to beat the rest of the market, it's trying to get exposure to the market. So FTSE 100 is an example of sort of a passive group of stocks. And so the idea was that if you can get the right types of companies and you can get large enough of them, you can start to try and get closer to the 19, 20, 21% investment returns that the average sort of is able to achieve. There are individual investors who do a lot more than that, and there's unfortunately lots of investors that do a lot worse. So built and designed that was a brilliant project. I'm super excited by it.
Can you tell what the returns are yet? No.
Yeah, it's still a bit early. I left there nearly 2 years ago now, but at the time our most important metric was prevention of failure. So what we didn't want we didn't want attrition, so we didn't want any death in the portfolio. We were still able to deliver gains on paper, no exits in in those funds, I think. But we had an exit in a company that was meant to be in there, but didn't get in time. But so things will start happening, should start happening in that, over the next couple of years, I thought. But it's not about, the whole concept was not to try and be better than like the average. What it's trying to do is, in the most efficient way, get the average. And that's a long-term play. And that's having a large portfolio. So it was called Fund 28. The concept was to get at least 28 investments in a portfolio for a single investment as an investor. So you put your, 5-10 grand in, and with that single investment, within 12 months, you'd have 28 companies at least. A bit like momentum trading, where you kind of, if lots of people invest, then there's an argument to say that if you invest with the momentum, you get carried a bit by that momentum, and then you can exit a trade and make a gain. It's a bit like that. So if the appetite was very large from the retail investors, then the fund would take a larger position in that company. And if it was very small or not enough, it would just not get engaged. So interesting model. And I think, time will tell, but I think that's a space. The passive space, I think, is something that could really grow.
So then you left, and then you started working where you're working now. Where you're investing in a really early stage. So that means you must really like the early stage. So, because I found that, with the people I speak to, whether it's investors or founders, people tend to either like the early stages, or they like the less messy later stages. Yes. In fact, I spoke to a really successful founder recently, and his company, the company he co-founded, was actually growing and doing really well, and essentially has become stable. And he left. He's now started another thing, which is, a mess, and there's no money, and there isn't really a plan. And he said, "I love it. I'm back to what I like." And so I'm assuming you like that too, but I can't tell me.
So it's weird. So I have a brain that doesn't really like repetitive work. So my job was to find efficiency all the time, like that. My original technology hat was just efficiency. If you can do something in a better way, cheaper way, faster way, more accurate way, or whatever, do it that way. Build a system that can manufacture something by through robotics or whatever. But you do that, but then you don't sit and watch the robot all day. And I just never sort of was drawn to, okay, well, we've now got this new manufacturing site built, and I use it as an analogy because it's sometimes easier to kind of, for me to think about it in that way. I've designed a whole manufacturing line, assembly line, or whatever it is. After it's all built and all the testing's done and all the problems are ironed out, and then you're looking at maybe making it slightly, very incremental improvements. You've really got a job then of monitoring. So who are doing all the staffing? Who's doing all the payroll for these people? How are you going to operate, making sure that they all turn up at the right time? Who's going to manage all the metrics for the machines? Who's going to operate the maintenance? Who's going to do? And it's just a list of all these different tasks that then are about doing the same thing every day and making sort of small incremental improvements. And I just don't have a natural affinity to doing that.
Since most of our audience are non-technical people, but they want to participate in the tech boom. Yep. Some of them are either aspiring or existing non-technical founders. Some of them want to be angel investors or get jobs on VC, and some of them don't know what they want to do. They just know that the tech sector is big, and especially kind of my generation. So we graduated at the same time. I saw, say, 2005, and a lot of people, were going into essentially the city, which for our American audience is Wall Street. So it was like banking, consulting, that was the thing. And now I'm seeing a lot of those people essentially trying to like squeeze themselves into the
technology. Yeah.
Yeah, because that's where the money is. That's more interesting. That's kind of where the cool kids are these days.
There's some money. I mean, there is money. I think also just jumping in, we've got. It was very strange. So working in a startup on, not good money. Like you don't get paid well.
Tell me about it. Yeah.
Like and I came out of a consultancy where, at the end of the month, you sort of try and make everything work to make sure everyone else gets paid. And then when you tally it all up, you realize you're probably on like half of what you were on when you were previously working. Anyway, like it's not like you make tons of cash initially. Anyway, the whole point is deferred gratification.
The whole point is that you will earn money one day. I know.
One day. And so being approached by people, investment banking, MD, 25-year career, on hundreds of £1,000s a year, plus hundreds of £1,000s of bonus, and they have millions and millions of pounds, and they're going, what is it you're doing? It's super interesting. Why are you doing this? You're like, I'd really like to get in that. How do I get involved in that space? And I'm sitting there going, like you're getting paid a fortune. It's like, yeah, things are fine. I got lots of cash, but got lots of bills. Got 3 kids in private school, and that's like 40-50 grand a kid a year, or whatever it is, and and I'm like, well. It's not necessarily that they're chasing money. I think some of them are actually just chasing enjoyment and something of interest and something of worth. Like, I'm not saying banking is not worthwhile. Many aspects of banking I really struggle with to see that they add much value in the macro sense, but it generates lots of money. But for not necessarily in the greatest way, but I think there is an element that it's interesting.
The reality of the more startup-y world, whether you're on the investing side or, we're all on the investing side because founders are investing their time and their energy and investors are investing their money, but it is a deferred income situation.
Yep.
And that can be, some people are happy with that and some people are not, but I do think that that's something worth it for people to think about. And if people want to earn well and work in the tech sector, Facebook pays quite well. Facebook pays good salaries. So working in product management, working in UX at a big tech firm, that's a good way to essentially be part of the tech boom and still earn quite well.
I think the venture capital community get paid well. Like it's not a badly paid life. It's just that,
I think we know that.
but especially in the smaller funds, really, I could earn a lot more on a monthly basis doing something else. But one, I just love what I'm doing, and two, it is delayed gratification. I'm willing to take a lower paid job now for even. And it's not, if it was guaranteed, it would be a different situation because everyone would make that choice. Like it is a chance that it's all not going to work out as well. So, you have to kind of take that judgment call about whether that balance works for you.
Wasn't that so useful? We covered a lot in a short amount of time. As we mentioned in this episode, venture capital and tech entrepreneurship are just 2 ways to join the tech boom. There are others, and this is what this treat is all about. On the 26th of April 2021, I'll be teaching a free class on how to transition into a career in tech. I will show you 5 different case studies of people who don't have a technical background and have successfully transitioned into tech, and I will show you how they did it and what they are doing. If you think you want to work in the tech sector, but you don't know where to start, then join this session. The link is in the show notes, or just go to techfornontechies.co/career-masterclass. That techfornontechies.co/career-masterclass. If you join live, you can ask your questions and get some practical suggestions for what steps to take next. So it's going to be fabulous. Come and join. If you're loving what you're learning, which I hope you are because this is fabulous, then come and join me at Tech for Non-Techies as a member. Our membership is your best friend in tech. Every week we have live sessions with experts like James, and we have masterclasses with me, and you also get monthly member meetups. Our next member meetup is actually happening on Monday, April 12th. So if you sign up now, you could literally join us then. So literally, what is not to like? It is your best friend in tech. So that's it for now, smart people. And I'll speak to you next week. Ciao.